Boom! What is up, Waves Capital? It's Royce Jacob. Welcome back to the channel. And in this video, we are going to be taking a look at a few different historical indicators that could give us some insight as to how and when this bear market may finally come to an end. Okay, so we will be diving into the charts because I do definitely want to talk technicals around the S&P 500 with you guys. The reason we're looking at the S&P 500 is because this is the benchmark index for the US equity markets. Therefore, when the S&P 500 bottoms out, it's pretty likely that the macro bottom for the majority of stocks across the board is in. Okay, so do have some time horizons, do have some price targets that I'm personally looking at that we will be discussing near the end of the video. But I want the primary focus of this video to be on the fundamentals, because ultimately we have a lot of macro catalysts and macro headwinds, potential headwinds, I should say, on the horizon. And right now is a very, very important time to focus on the macro, okay? Even if you trade individual stocks like we primarily do over at Waves Capital, it's important to understand the macro, because as we've learned over this past 6 months, more than probably the majority of our trading careers or investing lives, whether you're recreational or professional, is that the macro matters, right? Pretty much what the Fed is doing, what's going on in the macro, geopolitical, economic events, those all will affect your bottom line regardless of how you're trading, okay? If anything, it gives you some insight as to general price direction, okay? So always important to discuss the macro. The primary way we are going to be doing that today is by reading over this CNBC Pro article by one of my favorite macro analysts in the game, titled Evaluating When and How This Bear Market May End. That macro analyst and author is Mike Santoli. So credit where credit's due, because this is a great article. He really curated a strong set of data points that, once again, the purpose of this video is to hopefully give us some indication as to when we can start feeling bullish on the markets again. From, long-term perspective is easy to say you can be bullish. 5-10 years, it's easy to be bullish and trust that things will go up over that time horizon. But when it comes to feeling like the market could be higher 6 months to a year from now, from today, that's really the question we want to address, and that is what I want to talk about in this video. And I will say before we get to reading it all that I don't think the macro bottom is in just yet, but I do think that we're closer than we have been, and that the macro bottom is closer than not, okay? And I do think it's coming pretty soon. Now, we'll explain that as we dive into the charts, okay? So, that said, let's get to reading. This is a bit lengthier, so sit back, grab a drink, cheers up, and let's go. So, markets under stress and strong macro crosswinds move in jerky, dramatic ways because asset prices need to travel far to locate a buyer or seller with conviction at any given moment. While the simple story of Wall Street 2022 is don't fight the Fed or tape, after a near 25% S&P 500 loss and the worst stretch for bonds in decades, the behavior can be held differently from one eye to the next, can be beheld. The recent action can be described variously as a promising but messy retest of the June market lows as the valuation and interest rate reset runs its course, or as yet another brief moment of relief before a further cascade lower in the face of a Federal Reserve that feels straitened financial conditions are the medicine itself and not an unfortunate side effect. Among the questions it would help to have answered to sort out the plausible from probable are these. What's priced in the markets already? Will newly generous bond yields outcompete stocks for investor dollars? And is a climactic investor panic a prerequisite for a recovery to take hold? What's priced in? The market as a whole has repriced pretty dramatically this year, which is not to say it'll prove to be enough. The S&P 500 at September 30th low of 3585 was off 25% from the January 3rd peak. So, peak to trough in 2022 was 25%. Pretty solid correction. But this clarifies on that, and this is why during recessionary times, as we'll also look at over here what this price range is, I'll explain that more as we dive in here. But during recessionary times, the average correction is different. And that's what we'll talk about right now. To reach the median decline for all recession-related bear markets since the 1930s would mean merely a 27% total drop to 3,500. Notes RBC Capital strategist Lori C. The average of all such declines would mean a 32% loss and a visit to 3,260. And this level does make sense. And we'll talk about that more as we dive into the charts once again. Sorry to leave you guys hanging, but we got to finish this, okay? 32% loss in a visit to, once again, 3264, the SPX. We are looking at the SPY, but it's pretty much just you take off the 0, and that's the SPX, which is the S&P 500. The SPY is an ETF, the SPDR ETF that tracks it, okay? So the valuation reset has been swift and significant for the S&P 500 from 21 times year-ahead earnings in January to 16 now. So from 21 times year-ahead earnings to 16 times year-ahead earnings, which is near the modern day average, but from a top-down view, not yet cheap from a historical perspective. Yet, as noted here, the valuation setup remains rather top-heavy. The premium accrued in the mega cap growth boom, not yet fully unwound. Apple and Microsoft are still near 22 times forward profits. Amazon and Tesla north of 40. The equal weight S&P 500 is now trading at 13.5. The S&P 600 small cap is scrapping multi-decade lows in PE, which is price to earnings, both in absolute and relative terms. Okay, so I do want to talk about this now because I've been saying this a lot in the newsletter. The war isn't over until the generals are shot. Now, that's obviously an analogy, but that means that the back row bottom is not in until the big dogs have been taken down, until the big dogs have reverted to their means. Personally, who I see as those big dogs who have not yet corrected enough are Apple and Tesla. And as you guys would know, we've made Waves Capital. We've made a lot of money with Tesla puts over the past couple of weeks now, and Tesla actually has recently tested its bottom. But Apple, I would view as the last standing general. Apple, Waves Capital, we currently have some Apple puts. Apple has not yet retested those June lows. And as I've been saying in the newsletter a lot, almost pretty much every newsletter over the past week, Apple needs to revisit its June lows prior to the markets bottoming out, okay? Because the S&P 500 is a market cap weighted, and Apple is the largest company, public company in the entire world. So obviously the United States S&P 500 as well. Their charts are going to look similar, so just keep that in mind, you guys. I do think Apple will fall further. Money's always where my mouth is, and therefore the S&P 500 should fall further as well. Maybe not as much, but I do think it will fall further, okay? So on that note, before we continue reading, you guys, if you want to know how I am trading, if you want to know how we've been able to profit, how Waves Capital has been able to profit over the past week, because in the past 7 days, our options portfolio, which consists of puts, some shorter term puts and some longer term calls for full transparency, we're up about 10%, okay? And I'm excited to hopefully redeploy some of these puts into more calls in some of our favorite growth names, okay? This is an example. Just want to show you guys this example from today's Price Targets newsletter. This is the second newsletter that I send out every single day. Trading day at least, Monday to Friday, unless there's a holiday, of course. And in this, we cover a bunch of different charts. Today, we covered Lucid, ChargePoint, Luminar, SoFi, Bitcoin, and Riot. Okay, so if you want daily updates on these, if you want daily price targets, because although I'm not making as much YouTube content these days, I'm always pushing on the newsletter, and I really do enjoy just the newsletter dynamic and kind of the more intimate Waves Capital portfolio newsletter investor trading group relationship. Okay, so straight up there, if you do want to join Waves Capital for real, you want to step up your investing and trading game, first link in the description box down below. That'll take you to this page. From here, obviously hit this guy. That'll take you to this page, and then you can choose whichever of these pricing plans you would like. Okay, so $15 a month, $40 for every 3 months. Try it free for 7 days. Unsubscribe if you don't like it, but I trust that you will be sticking around. I don't know why it does that, but I appreciate you guys joining the team if you do, and if you do, welcome to the winning team in advance. All right, so that said, let's keep reading, then we can dive into the S&P. There might be no contention more broadly embraced by the consensus than forecast earnings looking too high into 2023. It's tough to dispute the notion that estimates have downside given margin pressures, surging US dollar, and decelerating global growth. Yet, it's not as if analysts have been oblivious to the risk. Deutsche Bank notes that third quarter S&P 500 forecasts, ex-energy, have dropped by 8 percentage points since last quarter's reporting period. This very well should lower the hurdle for companies to meet or beat expectations. Through 2023 results almost surely have room to the downside. though 2023 results almost surely have room to the downside. There we go. It's also popular to argue that higher bond yields mean equities need to cheapen a lot further. Though the historical record is quite mixed on this, a model based on the 2-year treasury yield suggests valuation should compress more. But rates were higher than they were now in the 1990s, and PEs remained higher for years. The current yield on investment-grade debt indexes, around 5.6%, is right at the 35-year median, says Bespoke Investment Group, which hints that roughly average equity valuations are not far out of whack. It truly does come down not to stock versus bond algebra, but whether the Federal Reserve is intent on throttling the economy and driving a recessionary decline in corporate profitability. And this is what we covered in the last video. And again, you guys, if the Federal Reserve decides to ease up on the brakes before they actually decide to pivot and slow the rate raising, stop raising rates and even consider reversing and lowering rates, they cannot say that until they actually want to do it, because that will then, the markets and investors will then price that in, and it will undo things before they've been able to undo them physically. Okay, so very important for them to steadfast until they're actually ready to reverse course, which is pretty unlikely to happen anytime soon. That's the reality of it. So to close it out, is more panic needed? There is no single textbook manner in which bear markets end. Often there is a crescendo of panic reflected in wholesale liquidation of stocks and a desperate bid for downside protection that registers in a vertical spike in the volatility index to a new high near or above 40. Then there are times when a combination of time and grinding price declines continues until selling dries up and investors lose interest. I think we can all agree investors have been losing interest for a while now. I mean, the YouTube videos have slowed down. The markets, you just look at the market. If it's going down, there's probably less and less people that are interested in the markets. But you know, you guys, if you're still here, if you're still playing the game, if you didn't get cleaned and you still have capital to invest, things are getting pretty attractive. And valuations are getting pretty appealing. Again, not quite there just yet, but I do personally think that opportunity and some great opportunities are present right now. But I do think we'll have one more flush and some even better opportunities in the very, very near future. Again, close it out soon. Let's wrap this up. Okay, both heading into the June lows and in late September, the selling intensity got towards historic washout conditions. Things can always go to further extremes, of course. The VIX has been spending extended days above 30. Institutional equity exposures are near extreme lows, approaching levels of the COVID crash, and before that, 2016 and 2011, according to Deutsche. Apple utilities and other perceived havens have recently succumbed, a part of the slow motion surrender that should occur. Again, war ain't over until the generals are shot. The decline in margin debt in recent months has just touched overdone threshold, according to Ned Davis Research, which is building towards a contrarian bullish signal, though went deeper before major bear market lows were in 2002 and 2009. Okay, so you know what? This is very comparable. The macro is very comparable to 2002 and 2009, but with a more aggressive Fed. So again, you guys take some of these non-recessionary historical metrics with a grain of salt, because we are in pretty unprecedented times as far as the macroeconomic backdrop is concerned. These readings are flirting with some rare fat pitch readings, showing that the pendulum has already swung pretty far away from confidence and greed, but aren't quite to just close your eyes and buy status. Investors would probably be relatively lucky to have this market retrenchment culminate with valuation and investor positioning having come only this far, and with the S&P 500 still up a bit over the past 2 years. With seasonal factors improving and a payback year pretty far along, who's to say there won't be a break in the market's run of tough breaks before too long? Okay, I will say interesting quotes to close out the newsletter with, or this article with. But anyway, well written. Once again, shout out to Mike Santoli, my favorite macro analyst in the game, and of course, shout out to CNBC for providing the article. Let's close it out by talking some upcoming macro headwinds and where I think the S&P is going to bottom out, and when. I will say, I think there is a very possible chance that by the end of this week, the date of recording is October 11th. This Friday would be October 14th. I think by the end of this week, the S&P 500 could potentially see a macro bottom. Okay, that's a bold statement. Of course, we could fall further. That's where I'll take this 35% retracement as we zoom out. But in the short term, I will just say the CPI report, the September CPI report, which shows month-to-month inflation on pretty much every metrics. on pretty much every metric. Rent prices, gasoline prices, food prices, grocery prices, eating out prices, you name it. If it can inflate, it's going to be in the CPI report. Okay, some consumer price index report. This comes out on October 13th. That's this Thursday. This is probably going to be pretty bad. And I think most investors believe this is going to be bad, which also could lend itself potentially to it not having much of an effect on the markets regardless, unless it's surprisingly good. If this CPI report shows inflation cooling meaningfully, and I'm talking like a full percentage point, that's going to be good. If it shows it at the same levels or going lower, it's going to be bad. I don't think it's going to be as bad as some of these sell-offs have been in the past, like down 4 or 5% in a single day for the SPY and NASDAQ. But I do think it's going to be bad if this inflation report comes in hot, which I do. I don't see anything in my life getting cheaper personally, so just boots on the ground, anecdotal research. I don't think the CPI report is going to be good. I do think this will cause downside for the markets, and I do think the S&P 500 could see $340, which is about a 5% decrease from current levels by week's end. So, CPI inflation report right here. I do also think that my level of 340, which will zoom out, pretty much just to say I've said it so many times in the past, I feel it's not super necessary to clarify. But the February 2020 of all-time high prior to, again, the pandemic sell-off in March of 2020 was at 340 for the S&P 500. Economic conditions worse, consumer spending habits worse. Pretty much everything from a financial markets perspective is worse. And it doesn't make sense for us to be above the February 2020 high after a very, very solid rally in the year leading up to that. Okay, so mean reversion, cyclical mean reversion. Bitcoin's there. Previous high, $20,000 back in 2017. Bitcoin's below that. Could it go a little lower? Absolutely. But cyclical mean reversion leads me to believe, again, playing so many boom and bust cycles over the course of my career, that you need to revisit the initial high or the previous high from the overall rally. Okay, you could say initial high. That usually works in shorter term bull cycles, which definitely does apply to a lot of other trades we're taking. But in terms of the S&P 500 and kind of this more macro time horizon, I do think we need to revisit the February 2020 high. I do believe that will signal official cyclical mean reversion, and that's personally where I would be comfortable getting bullish on the S&P 500 again, or just getting bullish on the U.S. equity markets overall, because once again, the S&P 500 is the benchmark index, 500 biggest companies in the U.S. Okay, so sums up the U.S. equity markets the best. I do think the SPY needs to come down at least another 4 to 5%. Where does this come to on a shorter term on a shorter term technical perspective? The SPY, since August, has been in a very, very clean descending channel. Okay, the line of support, this line right here, is the line of support on this descending channel. Intersects perfectly with that 340 level on October 13th. Or I guess end of day October 13th, maybe beginning of day October 14th. Could we come down a little lower? Okay, could we come down lower and test 335, 338 if the CPI report is bad? That would take us to Friday, the day right after the CPI report. Would make a lot of sense from a technical perspective. So, nonetheless, I do think the SPY will come down to 340. We could absolutely go lower, and I will go to the daily candles to close out this video. But personally, in my opinion, I think 340 is going to be the macro bottom for the S&P. If that comes directly after the CPI report, there's not much else aside from terrible Q3 earnings, which should be for the most part priced in, and just like demand destruction and guidance estimates should be pretty slashed. So what I think is gonna happen: CPI report drops, markets flush out one more time, investors are allowed to price in all foreseeable macro headwinds into the markets. That occurs on Friday because the markets sell off going to the weekend typically anyway. So I do think Friday we could see a macro bottom. I do think next week we could start picking back up again. And we'll see. But ultimately, again, during recessionary periods after 2000, I think this article said 32%, but that was not after 2000. I remember mentioning this in a previous video, maybe a month or so ago. But historically, after the year 2000, during recessionary times, so again, 2002, 2007, or 2001, 2000, dot-com bubble in 2000, the housing crisis in 2008, we saw 35% corrections. That was the average, okay? This, again, just given the efficiency of the markets and how markets kind of exponentially age over time, I do think 35% is possible. That would take us down to, again, about 310 on the SPY, or let's see, about another like 13% down from here, current levels at just under 360. So I do think that's possible. But personally, once again, I think 340 is the level that I'm eyeballing. And that is where I'd personally be comfortable buying the SPY. Okay. Until then, Waves Capital, we are hedged with puts. I'm ready for a little bit more bloodshed. Not too much, but just a little bit. And I'm excited to redeploy some of those put profits back into some of my favorite long-term plays. Okay. So we'll call the video there, you guys. I appreciate you watching. Again, if you want to join Waves Capital, step up your trading game. First link down below. And if not, I'll catch you in the comments downstairs to talk about whatever you guys want. Until next time, always remember, take action. Make waves. Peace.